This is a weld. Specifically, it's an X-ray image of a pipeline weld taken at kilometer marker 1847 of the Power of Siberia 2 pipeline, a joint where two sections of 1,420 millimeter diameter steel pipe have been fused together under conditions so precise that the resulting bond is stronger than the metal on either side. There are 847,000 welds like this one along the pipeline's full route. Each one is documented, numbered, and archived in a database maintained jointly by Gazprom and China National Petroleum Corporation. This weld was completed on November 3, 2025. You didn't hear about it because pipeline welds don't make headlines, but this particular weld sits at the point where the pipeline crosses from Russian territory into Mongolia, the last sovereign border before Chinese territory. When gas begins flowing through this weld in late 2027, it will mark the completion of a $400 billion infrastructure project that permanently redirects Russian energy exports away from Europe and toward a customer that will never impose sanctions, never demand political concessions, and never threaten to find alternative suppliers. On January 12, 2026, Presidents Putin and Xi signed the final implementation protocol for Power of Siberia 2 during a ceremony in Beijing that Western media covered in approximately 200 words. The protocol commits Russia to delivering 50 billion cubic meters of natural gas annually for 30 years, at prices indexed to Chinese domestic benchmarks rather than European spot markets. The total contract value, including infrastructure cost sharing and upstream development rights, exceeds $400 billion. This is not a trade agreement. This is a marriage, a binding of two economies through physical infrastructure that will outlast every politician who signed it. Here's what they're not telling you. Power of Siberia 2 is the second major gas pipeline connecting Russia to China, but it's fundamentally different from the first. The original Power of Siberia, completed in 2019, taps gas fields in eastern Siberia that were never connected to European markets. It added export capacity without subtracting from European supply. Critics dismissed it as symbolic, a prestige project connecting stranded reserves to a new customer. Power of Siberia 2 is not symbolic. It connects to the Yamal gas fields in western Siberia, the same reserves that fed the Nord Stream pipelines, the same molecules that heated German factories and Polish homes for 3 decades. When Power of Siberia 2 reaches full capacity, approximately 98% of Yamal production will flow east rather than west. The infrastructure that once made Europe Russia's largest customer will instead make Europe irrelevant to Russian gas strategy. The route itself tells the story. The pipeline runs 2,600 kilometers from Yamal through Mongolia to China's Xinjiang province, then connects to China's west-east pipeline system for distribution to Shanghai, Beijing, and the industrial heartland. The Mongolian transit was negotiated over 6 years, with China providing $8 billion in infrastructure investment to secure Ulaanbaatar's cooperation. Mongolia will receive $1.2 billion annually in transit fees, more than 10% of its current GDP, creating economic dependence that ensures the pipeline's political security for generations. At 3:45 a.m. Beijing time on January 13th, the first compressor station on the Chinese section of the pipeline completed its acceptance testing. The station can push 137 million cubic meters of gas per day through the system, enough to supply all of France's daily consumption with capacity to spare. 14 more compressor stations will be operational by mid-2027. The infrastructure isn't being built, it's being completed. This is the physical manifestation of a strategic decision made years ago. Russia will never again depend on European customers, and Europe will never again have access to Russian gas at prices that made its industry competitive. This is where the lie becomes unsustainable. European energy policy since 2022 has operated on an assumption so fundamental that it's rarely stated explicitly. Russia needs European customers more than Europe needs Russian gas. The assumption held that economic pressure would eventually force Russia to seek accommodation, that sanctions would create leverage for negotiated settlement, and that the cost of losing European markets would constrain Russian behavior. The assumption was wrong, not because Russia doesn't feel pain from lost European sales, it does, but because pain is relative, and Russia found customers willing to absorb its full export capacity before European pressure could become decisive. Chinese gas imports have grown from 52 billion cubic meters in 2020 to 167 billion cubic meters in 2025, a tripling in 5 years driven partly by domestic demand growth and partly by strategic stockpiling that positions China to weather any future supply disruption. Power of Siberia 1 currently delivers 38 billion cubic meters annually, with capacity expansion to 44 billion underway. Power of Siberia 2 will add another 50 billion. A third pipeline, Power of Siberia 3, routing through Kazakhstan, is in preliminary planning for an additional 35 billion cubic meters. Sum those figures and Russia's committed pipeline capacity to China reaches 129 billion cubic meters by 2032. Add LNG exports from Arctic facilities, and total Russian gas deliveries to China will exceed 160 billion cubic meters annually, almost exactly matching what Russia exported to Europe at the peak of dependency. The customer base hasn't shrunk, it's been replaced. And the replacement customers are more attractive than the originals. They pay reliably, they don't attach political conditions, they don't threaten sanctions, and they're growing their consumption at 8% annually while European demand contracts. For every cubic meter that Europe refused to buy, China was willing to purchase 2. The leverage that Europe thought it held was an illusion that Russia has now permanently dispelled. When institutions do this, they're not managing risk, they're containing disaster. On January 15, 2026, the European Commission's Energy Security Task Force held an extraordinary session that internal calendars had blocked as strategic planning retreat, bureaucratic language designed to avoid press queries. No official readout was provided, but sources present described the session's focus as post-transition dependency mapping, an assessment of what European energy security looks like after the transition to renewables is complete. The mapping revealed uncomfortable truths. Even under optimistic scenarios, Europe will require 180 to 220 billion cubic meters of natural gas annually through 2045 for industrial feedstock, backup generation, and heating applications that electrification cannot reach. Current supply arrangements, Norwegian production, North African imports, and LNG from global markets can reliably deliver approximately 160 billion cubic meters. The gap must be filled by spot market purchases competing against Asian buyers whose economies are growing while Europe's stagnates. China's gas consumption is projected to reach 650 billion cubic meters by 2035, more than double current levels. India's consumption will reach 120 billion cubic meters. Southeast Asian demand is growing at 7% annually. Every LNG cargo that Europe purchases is a cargo that Asian buyers also wanted, and Asian buyers are increasingly willing to sign long-term contracts at premium prices that European utilities cannot match. The Power of Siberia 2 contract locks in Chinese supply at prices 15 to 20% below current European spot rates, with escalation clauses tied to Chinese inflation rather than global energy markets. This pricing structure means that as global gas prices rise, Chinese industry gains cost advantage while European industry loses it. The contract doesn't just secure supply for China, it weaponizes supply against European competitiveness. Less than 24 months remain before Power of Siberia 2 begins commercial deliveries. When it does, approximately 50 billion cubic meters of gas that might theoretically have flowed to Europe under different political circumstances will instead flow to China under contract terms that extend to 2057. By the time the contract expires, European grandchildren will be debating energy policy in a world that has moved beyond hydrocarbons entirely. But the 3 decades in between will be shaped by infrastructure decisions made in January 2026. While one side disconnects, the other side integrates. The pipeline itself is only the visible component of a deeper integration between Russian and Chinese energy systems that extends far beyond gas. On January 8, 2026, Rosneft and PetroChina signed a 15-year crude oil supply agreement covering 100 million tons annually, approximately 2 million barrels per day, making China the destination for 45% of Russia's total oil exports. The agreement includes provisions for yuan-denominated settlement, bypassing dollar-based payment systems that U.S. sanctions could theoretically interdict. On January 11th, Rosatom and China National Nuclear Corporation announced a joint venture for uranium enrichment, with Russian technology transferred to Chinese facilities in exchange for long-term fuel supply commitments. The agreement positions the partnership to capture 30% of the global nuclear fuel market by 2035, a market that will grow as nations pursue low-carbon baseload generation. On January 14th, the Russian Direct Investment Fund and China Investment Corporation announced a $10 billion joint infrastructure fund targeting connectivity projects in third markets, diplomatic language for pipelines, ports, and power plants across Central Asia, Southeast Asia, and Africa that will extend the Sino-Russian energy partnership into regions currently served by Western companies. These agreements were announced separately, covered briefly, and forgotten quickly. But taken together, they represent something unprecedented: the creation of an integrated energy bloc that controls 23% of global oil production, 38% of global gas reserves, 45% of global uranium enrichment capacity, and the infrastructure to deliver these resources across Eurasia without touching any system that Western sanctions can reach. The dollar-based energy trading system that has defined global markets since 1974 is not collapsing. It's being bypassed by a parallel system that doesn't need dollar settlement, doesn't route through Western banks, and doesn't require Western approval to function. This is not about one pipeline or one contract. This is about the infrastructure of an alternative economic order, one that Europe is structurally excluded from. The mathematics of the trap are now inescapable. Europe faces a configuration of constraints that no policy can resolve on timelines that matter. Constraint 1. Volume. European domestic production is declining at 5% annually as North Sea fields deplete and Dutch extraction ends. Norwegian exports have plateaued at 115 billion cubic meters and cannot expand without new field development that takes a decade. LNG import capacity has grown, but global LNG supply is already fully contracted through 2030, with Asian buyers holding options on most uncommitted future production. Constraint 2. Price. Russian pipeline gas reached Europe at approximately $8 to $10 per million BTU before the war. LNG replacements cost $12 to $15 per million BTU at current rates, with futures markets pricing $14 to $18 through 2030. The $4 to $8 per million BTU differential translates to approximately 35 billion euros in additional annual energy costs for European industry, a permanent tax on competitiveness that compounds every year it persists. Constraint 3. Time. The energy transition requires 15 to 20 years to reach completion under realistic scenarios. Throughout that period, Europe remains dependent on gas imports from suppliers who have alternatives and leverage. Every year of elevated prices is a year of factory closures, capital flight, and skill loss that makes the post-transition economy weaker than the pre-crisis economy was. Power of Siberia 2 doesn't create these constraints. The constraints emerged from decisions made in 2022, when Europe chose to sever Russian energy ties without having replacements ready. What the pipeline does is eliminate the possibility that future political changes could restore access to cheap Russian gas. The molecules are now committed to Chinese customers through 2057. The infrastructure physically cannot serve European markets. The option no longer exists. The trap is that Europe cannot return to the past and cannot reach the future without traversing a present defined by energy costs that erode the industrial base needed to fund the transition. Every year in this present is a year of structural decline that the eventual transition cannot reverse. This is what a system looks like when the only exit is through, and through takes longer than the system can survive intact. The informed are not waiting for official announcements to understand what's happening. European industrial gas futures have entered a pricing regime that analysts call permanent premium, prices that reflect not temporary disruption, but structural scarcity extending indefinitely. The forward curve shows no return to pre-war levels through the farthest dated contracts, contradicting official projections that assume normalization as transition proceeds. Capital flows tell the same story. Foreign direct investment into European manufacturing fell 34% in 2025 compared to 2019 baseline, while investment into U.S. manufacturing rose 28% and investment into Asian manufacturing rose 41%. Investors are repositioning for a world where energy-intensive production no longer happens in Europe, not because of policy choices, but because of cost structures that policy cannot change. German industrial conglomerates have announced $47 billion in non-European capital expenditure since September 2025. BASF is building chemical complexes in Louisiana and Guangdong. Siemens Energy is expanding turbine production in Charlotte. ThyssenKrupp's hydrogen steel pilot will be constructed in Abu Dhabi rather than Duisburg. These are not temporary relocations. They are permanent reconfigurations of global production geography, driven by energy costs that European locations cannot match. Physical gold holdings at German banks have increased 23% year over year as institutional investors hedge against currency risks that official confidence doesn't acknowledge. The euro has depreciated 11% against the yuan since January 2025, reflecting market assessment that European competitiveness is declining relative to Asian economies with better energy access. Currency markets are pricing in structural disadvantage that political leaders won't discuss. The spread between paper energy contracts and physical delivery commitments has widened to levels not seen since the 2022 crisis. a signal that market participants trust physical supply less than derivative positions would suggest. When the paper market diverges from physical reality, it indicates that someone, somewhere, understands supply constraints that aren't yet reflected in spot prices. The question is not whether the Power of Siberia 2 pipeline reshapes global energy markets. The question is, who understands that reshaping well enough to position for its consequences? 847,000 welds along a 2,600-kilometer route, 30 years of contracted deliveries, $400 billion in committed value, and a permanent redirection of molecules that European industry once assumed would always be available. This is not a trade deal. This is geological reorientation, the physical infrastructure of a world where Russia exports east rather than west, where China secures supply while Europe competes for scraps, and where the energy relationships that define the post-Cold War order are replaced by arrangements that exclude the West by design. Physics doesn't negotiate, pipelines don't reverse, and reality eventually asserts itself over every strategy that assumed competitors would remain available as customers. The divergence between European energy plans and Eurasian energy infrastructure is now permanent. What happens next is not prediction. It's 50 billion cubic meters per year, flowing east through welds that will outlast every politician who failed to prevent them.